Okay, we're back. We are week 5. This is chapter 15 that we're going through. We're starting the financing portion of the course, and with that, um, the finance portion of your business plan will have the rubric associated with the grading of the finance portion or the finance plan. We'll have that posted in the next week or so. You'll still have plenty of time to work through that. To not only the draft, but also which will be due in several weeks down the road. But then the final financing plan, which will be due close to the end of the semester, and then that will need to be incorporated into your overall plan, of course, which is due the last week or so of the semester. But this chapter 15 is called Small Business Finance Using Equity, Debt, and Gifts. And of course, the finance chapters begin around, let me see, I think it's 13. Okay, yeah, 13 is actually where the finance chapters begin. But I felt that it's best that we start here with this chapter because it talks about the types of financing that you, or it at least incorporates the types of financing that are used a lot of times by businesses whenever they're getting started. And you have to get started, of course, before you can have cash from sales and cash flow. And so that's the reason that I have chosen to go first with this chapter 15 here. Okay, although we will be covering every chapter in the book, I think this one was it's more important for the development of your plan to see and hear this first and get you kind of started thinking about some of these things so that you can incorporate them in your plan. All right, and not talked about this too terribly much before, but the way that I've kind of approached a lot of these chapters so far is to not spend a whole lot of time on the learning objectives, the LOs, that are at the start of each chapter, and certainly not to go through and read everything in the chapter. Just that's a reiteration of what you can do on your own time. I think this time is better spent telling you some things that are not in the book from my experiences over the years or from other sources that I have found. And so that's what we're going to do again here. However, I do want to go through some of the things here and kind of talk about how they tie in. The learning objectives here on, what page is this? The second page of the chapter is 477. There, describe the 3 types of capital financing and their costs and trade-offs. Explain the characteristics of a business that determine its ability to raise capital. Determine the best type of financing for your business, and describe the differing needs for financial management at each stage of business. And we're not going to do all of those here, but I want you to hear them from me and understand that the things that we are going to talk about do tie back into those learning objectives. So be aware of that and try to identify that as we go forward. Okay, I'm going to go through some things that are not in your book first of all. Well, no, actually, we will kind of zip through this. We've got more time than I expect. I'd honestly expected to find more videos that had already been made that I could post for you. However, I wasn't able to find as much as I wanted to. Things that I really liked and felt like would guide you in the right direction. Also, that's another thing. And so you've got a few videos there, and one of them, well, a series of them, 5 of them, are from a bank in Australia. I hope the individuals that are speaking there, their accent is not so thick that you can't understand it. And even though it is from Australia, the principles that they talk about are true for any commercial bank when they're looking for the things that they're looking for when making a decision about whether or not they want to lend to someone, in a business setting. Okay, so we're going to go through some of the things here. Page 479. 478 starts it and it carries over the bulk of it. Starting on page 479, talks about the sources for small business finance. The first one obviously is well, no. Let me back up. the first and primary source is owner funding. Okay, and that can come in many forms from many sources. Personal, taking out of personal savings, taking out of retirement savings, taking out taking a cash advance on a credit card, borrowing from friends, family, having them give you money. I think there's one section in here that talks about gifts in your textbook. Having them gift money to you with no expectation of that money being returned to them. Those are some of the first sources, and I can't remember if I've used this phrase or not in previous chapters, but there's a term out there, the three F's: friends, family, and fools. And that the FFF, that is a phrase that's used for talking about the only people who would be crazy enough to invest in your business at the early stages are your friends, your family, and fools that don't know any better. And that's unfortunate, but it comes from experience, as do many things in life. From seeing that so many startup businesses, and we talked about this in the first weeks, that so many startup businesses fail within just a few years' time. Some even sooner than that, honestly. They aren't officially dead until 4 or 5 years down the road, but for all intents and purposes, they were dead. Some of them within the first year, and so really that's where this comes from. Only a foolish person would put money into a startup in those early days. So that's so remember that the friends, family, and fools. Now I don't believe that was in our text, but it's certainly something to think about as you go forward and you're thinking about, oh well, I've got an aunt that's going to give me some, surely she'll give me some money. She loves me and she wants to see me do well. Well, if they have money, they have it for a reason. It's because they've been smart, they've been frugal, and they've not just been loose with their spending. And so they're gonna, if they understand. Now, granted, sometimes they will just because they love you. They'll give you money, but many times they're going to want to see a return on their money. There was a famous quote many years ago. Oh gosh, what was his name? I'll try to find his name before we get done here. But the quote goes, "I'm not worried about the return on my money. I'm worried about the return of my money." Will Rogers, maybe. I'll look that up hopefully before the video. We end the video here. So. And that's true with a lot of investors these days. They are not concerned. They certainly want to get something for the risk that they're taking, but they're more concerned about getting their money back, and that's what that quote means. Not as concerned about the return on my money as I am the return of my money. Okay, so financing with equity, certainly putting your own money into it is equity. You are taking an ownership percentage in the company. Won't get into the details of how that's structured. With from an accounting standpoint, we don't have the time and the ability to go into that much depth. That's for reserved for a more detailed course on the financing. Where you can spend literally weeks. Up to a full semester at a time on that can be studied. So, but personal equity, and it comes from a number of sources, and we talk and on page 480, talks about some of these sources of where you can get the different types of financing. I mentioned some: credit cards, personal savings, retirement savings, those kinds of things. Um, let's see here. You also can basically sell stock in your company, similar to. I hate to make assumptions, but many of you have heard about the stock market. Now that is when people talk about the stock market, that is publicly traded stock that has that's issued and is readily available for anyone that has a certain type of investment account. To buy into or to sell. However, there are thousands and thousands and thousands of companies out there that have private stock that is not publicly traded. And you can actually issue this stock, issue ownership in your company to individuals that want to buy into it. excuse me. Now, some may want to buy in the early days, before you even get started, and some may see how well you're doing, and then choose, seek you out and say, hey, I'd like to be a part of your company. I'd like to have some ownership. And it's beneficial. It could be beneficial for them. It could be beneficial for you also, because you, as potentially the primary or the only owner of that stock, it's a way for you to cash out and get some money for, even more money for the efforts that you've put into building that business. And certainly that is the one of the end goals for many business owners, is to sell out at some point, sell the stock in the company, privately. Usually, now a lot of times they'll go public, and we hear about those. When there's an IPO, an initial public offering, company goes public, and it's listed on the stock market. But there are only a few thousand of those out there, that are publicly traded. Most companies are private in nature, and but you can still do very well going that route. So you can sell ownership in your company by issuing stock, and the way to do that would be to partner with a good attorney and a good accountant. They'll help you through that process. Again, that's beyond the scope of this course. It's a little too in depth for a 16-week course here, but just understand that is an option, a way to raise money. Okay. Why would you use on page 485? Ask the question: why would you use equity capital? Three primary reasons: you'll reduce your own exposure to financial loss. Your business will not have increased costs in the form of interest, and outside investors bringing outside investors into an existing business can often re-energize it by providing new ideas, procedures, and processes. I want to talk a little bit about each of those three, and I'm sorry I'm talking fast. There's so much to cover. So I am going to talk fast throughout this whole video. You'll reduce your own exposure to financial loss. So what does that mean? Well, obviously, if you're the only person putting money into the business, and the business does not do well, it's all your money that's lost. Okay, so by bringing in outside investors, you may still have a 10, 20, 50, 70% ownership, but you've taken a slice of that pie, and you've changed the source of that money, where it's coming from. So you're not putting all of your money at risk. You're putting somebody else's money at risk. Now, for that risk, they're going to want a percentage of the company, a percentage ownership of the company, and that's for the two parties, with the help of an attorney, or maybe multiple attorneys, and a business valuation specialist, to determine how much of the company they get, whether it be 10%, 12%, 13.6%. I mean, you can get very detailed with it, in defining the level of ownership. Okay, so that's the point number one. Point number two is that your business will not have increased costs in the form of interest. And what that means is interest from borrowing. Okay, when you borrow money from a bank or from a private lender, you have to pay interest on that. They're not just going to let you use the money for nothing. Okay, they want to get their money back. Talked earlier about return of my money as well as return on my money. Okay, well they're interested in both. They've made a safe bet, if you will, that you're a good prospect for lending to. But with that, you're going to have this extra expense. You've got to pay back the principal portion, but you've also got to pay back an interest portion, and depending on what you agree to, it could be a minor, a small amount, or it could be a very substantial amount. But that's what they're talking about when they say increased costs in the form of interest. All right, and the third is pretty self-explanatory, but I'll read it again. Bringing outside investors into an existing business can often re-energize it by providing new ideas, procedures, and processes. A lot of times, outside investors will have a experience or a specialization in a certain area. Maybe they worked in the industry that you're in for years and just decided to give it up for whatever reason. They retired, or they moved to a different industry, or whatever. Maybe someone bought them out and sort of forced them to go to a different industry. But they still have an expertise in whatever it is that you are offering, and so they, as an investor, they can bring new things to the table. They may even buy enough of the company to where they demand a seat on your board of directors. Well, certainly with the board of directors, you want people who are going to provide input and feedback to the plans and directions that you have for your company. And so investors are the perfect place to look for those individuals that can sit on your board, that can be advisors. Okay, all right. Financing with debt, getting a loan for your business. There's a lot of sources out there. We talked in a previous lesson that banks aren't lending nearly as freely as they have in the past. However, as I said, and this was one of your test questions, banks don't make money unless they lend money. And so you've got to have your act together, have everything in order, and that's what these other the series of videos, the 5 videos from the bank, kind of talk about very quickly and succinctly. And I think it's a great short series of videos about what you need to do, and talks about the importance of a business plan from a banker standpoint. I've heard that from so many bankers that I know. That people come in there and they're looking to borrow money, and they have no plan, they have no idea what what they're going to do, what they want to do. Now they've got an idea, but an idea, I've said this so many times, an idea is not a plan. It's just not. You can have a great idea all day long, but until you put it on paper, it's not actionable. It's not something that you can. What that activity does, it really helps to hold you accountable for doing certain things. And so that's why I encourage people, put it on paper, detail it out. I met with someone the other day who had an interesting concept for a. It's not a new business. It's an industry that's been around for thousands of years, literally. But they wanted to put a new twist on it in this community that they felt was not being provided. However, their plan was about 4 pages long, double space typed. Not deep. Finances were not detailed out. They made estimates on the numbers. Well, we think we're gonna need $1,000 to do this portion. We're gonna need $5,000 to do this portion, $2,000 to do this portion, $500 to do this portion. And I asked them. I said, well, all right, this is great. It's interesting hearing about what you have in mind. What do you want from me after going through the whole spiel? What is it that they were meeting with me about? Well, there were 2 things. One, they were looking for money. Now, not from me necessarily, but how to approach individuals, and if I knew individuals. And I had to tell them. I said, whether it's an individual investor or a banker, they're going to look at this and they're going to say, sorry, get out. Because if you've got nice round whole numbers, it tells that person, and we said this in a previous lesson, that you've not spent the time to understand what it takes, because they want to see exact numbers. Investors and bankers want to see exact numbers, and so it tells them that you've not spent the time in this one area, and that may very well convert to or transfer over to another area that you probably didn't spend as much time as you should have. And so that their level of confidence in you goes down immediately and very quickly. They're not going to want to lend money or to invest money in someone that they don't feel can carry out not only that plan, but any plan in general. And so encourage them to go back and give some more time and thought to the business plan. Do it more in depth. The numbers and just spending more time on it. Okay, and not just for the sake of spending time on it, just sitting and reading and thinking about it. You actually have to do something with it. All right. Okay, so there are a lot of sources here, starting on page 485 for lending. Now, just because, and then again, just because you've got your what you feel, all your ducks in a row, does not mean that you're going to get the loan. Banks are very tight with things now. They are becoming. Things are getting a little better here in 2012. Started in 2011. Some of the requirements, they're not that they're getting loose with them, but they're getting they're feeling a little bit better about the economy. And banks have to, you may have a great business, but if they think that the public in general is not going to be spending money on any number of things, and that's not going to trickle down to the type of business that you have, then it won't work at this time. And so therefore they may say, we can't fund it right now. They may fund it in a year from now. They may fund it in 2 years from now. And that's a good reason to continue to go back to that banker person, and don't just stop at one banker, or other private lenders. Continue to search out those individuals. Present your plan to as many people as you can until you can get funded with it. All right. Not going to spend time on reading everything here, but bankers look at 4 C's of borrowing, and those are listed here on 486: character, capacity, conditions, and that's what I just talked about. The conditions, the economy may play into whether or not they decide to lend money to you. You can have everything else, all your T's crossed and I's dotted, and you just can't help what's going on in the economy, and they just say, not now. There's a yes, there's a no, and there's a not now. All right. Page 490, we talked about personal gifts. I won't spend any more time on that, but certainly read through that. Page 492 and 93 talks about which types of financing are right for your business based on what it's going to cost you. Okay, and I'll tell you this. Well, the easy answer is that equity or selling stock in my company is the cheapest thing. I don't have to pay it back. Okay, well, that's great. And the other side of it is that we talked about at the very beginning of this video. If my business doesn't do what I think it is going to do, then at least I haven't put my money up. It's somebody else's money that's at risk. Okay? That is absolutely true. That is absolutely true. However, you have to think about it from this viewpoint. Do you believe in your business? Do you believe what you've put on paper or what you've got up here that's not yet on paper? And hopefully once you get it on paper and you have it in a presentable format, do you believe it strongly enough that you are going to be successful? Okay? If you do, and I'll tell you this because I've seen it many, many times. Excuse me. Selling stock in your company is actually more expensive than getting a loan. You say, well, how can that be? That sounds crazy. I don't have to pay anything for it. It doesn't cost me anything to get that money. They're giving me money. How is it expensive? Well, here's the thing. If you are successful, if you really believe you're going to be successful with this business, you're going to make a lot of money on it, then what you are going to have to give up in the form of ownership payout for that stock that person has taken away from you can be more costly in the long run than going about getting financing by way of debt or loan. Let me give you an example. Let's say that a person gives you $20,000, and for that, they want 25% of your business. Okay, you say, okay, 25%. It's not greater than 50. I've still got control. No big deal. 25%. Okay, all right, fine. Your business the first couple of years just kind of teetering along, and you're getting by, doing okay. But then year 3, 4, 5, you start things kind of start taking off a little bit. All right. Well, what's that going to do? You're going to have increased profits. Well, guess who gets a portion of those profits? The person the shareholders. You're still a shareholder. If you gave someone 25% of your business, you still have 75%. So let's say you end up making above what you paid yourself in the way of salary, and after all your expenses are covered, let's say you got an extra $100,000 in profits. That'd be nice, right? Okay. Well, out of that $100,000, you get to keep $75,000 of it because you're 75% owner. Okay. Well, the other owner also gets their share, which is 25%. You got to pay them their share. Okay, so what's 25% of 100,000? $25,000. Okay, how much did they give you? I think I said 50,000. Okay, well, all right. So let's say they only gave you initially $50,000. Well, in this 1 year's time, you've given them back 25. That is so much more than what you would have paid in the way of repayment, very likely, depending on how you structured the loan, but it's very likely so much more than you would have repaid in the way of principal and interest on any loan that you would have come to an agreement with them on. And not only that's just 1 year. And then you've got every year after that you're going to, hopefully what you want profits to increase because you've still got 75% ownership. They want profits to increase because they just saw that they got $25,000 in 1 year, which is so much more than what they would have gotten from the loan total of the loan payments. Okay, so there's a potential for an equity owner to make so much more than they could in a debt type of arrangement. Okay, so and that's the risk that they take. Certainly, there are businesses that go belly up all the time. That's the risk that they take, but they are looking for very high return, and they'll structure a lot of the agreements that way that are so that they're there so that they are to their advantage. And so I'm just telling you from experience that although you may absolutely cannot get around it sometimes, certain investors will want, and that's why they want it. They know that there's more potential in the equity portion for certain businesses. And some businesses, that's not the case. Some of them are just, very low growth, low profit. And in businesses like that, they may say, "No, I don't think so. We want the safety. We don't want to just give you the money. We want the potential for something in return." And so they may structure it in a debt format. Okay, so enough about that. All right, let's move on. Again, this calculations of which type of financing, the weighted average cost, the cost of capital, the weighted average cost of capital, those things are beyond the scope of this course. It's important to understand, but it's more appropriate for a finance-based course. But understand that it is something that needs to be considered when determining the type of financing that you pursue. Okay, the next few pages there are about a lot of financial measures, and certainly on page 497 it talks about a number of financial measures that are considered both internally and externally. These are some things that in your business you need to be monitoring. Inventory turnover ratio. I saw that. Margin ratios, return on equity, return on assets, activity ratio, liquidity ratios. A lot of these are also concerns that banks have. Now, certainly, that is true more so the further along you are in your business, after you've been in business for several years, and you may have hit a rough patch, and you're looking to get a line of credit or a loan to get you through a rough period. They're going to want to know how these financial measures, these index or these ratios, stack up for you. Where have they been? Yeah, we understand you're going through a tough time now, but where have they been? And get an understanding of what the prospects are for those coming back in the future, because they want some level of guarantee or some level of certainty that you're going to be able to pay back what it is that they're lending to you. Okay. All right, and then let's see here. On page 499 is a good graphic, the pyramid-looking thing that talks about the availability and the sources of financing, and of course at the very bottom is the most readily available. I guess it should say the most readily available. It may be the least dollars that you could you may not have a whole lot, but obviously it's the most readily available to you. On the top side of that dark blue box there is external loans from commercial rate lenders. That's the they have the most money to lend, but it's the least available to you, depending on which phase you're at in your business. Okay. All right. Let's see what else we've got here. I really like the chart here on page 500. It talks about angel investments, and let me see. I'll back up a little bit and try to find. Did we have venture capital? I'm sorry here. Searching. Accredited investors, $4.99. Okay. Yeah, accredited investors. This is a phrase that I deal with regularly, and tell you what this means and why it's important. Many of you may have heard the term venture capital or venture capitalist. These are individuals who are basically they're investment bankers. They're not the bankers that are at Regions or Wells Fargo, or whatever your community bank is. They're not that type of banker. They are investment bankers. They are seeking to invest in businesses, not lend to businesses. Although in some cases they do structure the financing as debt and not ownership. But we're talking about the investment side of it. Okay, what these individuals will sometimes do is they will put together a pool of almost like a mutual fund. I won't get into the details of mutual funds, but basically a pool where they have subscribers. These individuals will say, yes, Mr. Smith, I think you're a great investment manager, and I don't have the time, expertise to be able to go out and find these businesses that are going to be good prospects, good investments. And so what I would like to do, I'd like to give you some money and have you go and do that for me. Well, what they do, they put together this pool of assets from these types of individuals. They collect money from all these sources, these individuals, and then they bundle it all together basically. Then they go out and they are commissioned with finding these businesses, these small businesses that have high growth potential, with the prospect of yielding high returns. And so that's generically that's what a venture capital fund or a venture capital investment, how it's structured. Okay, well, not everyone can invest with those individuals, with the investment bankers, okay, and in this type of setting. The SEC, not the Southeastern Conference, but the Securities Exchange Commission, is a regulatory agency that has defined who can invest in this way, and they are called accredited investors. There are some requirements, and I believe that has been under review as to what the definitions of an accredited investor are. Let's see here. In the past, that has been individuals who have a total net worth of at least $1 million. Yeah, there it is on page 499 in the margin there. The SEC's term for individuals with a net worth greater than $1 million or personal annual income of at least $200,000 in each of the most recent years. And it doesn't say it, but they also have to have the expectation of having that same level of income in the upcoming year. So it's $200,000 if they're an individual. If they're married, that number jumps to $300,000 in income. And your book does not tell you that here, but that is. So obviously these individuals are very either wealthy, have amassed wealth, or they have a high level of income. And the thinking there is that these types of investments are riskier. And so therefore, an individual that puts money into these types of investments needs to have something else to help cushion the fall if, in fact, that business, they lose everything. Okay. That's the thinking from the SEC standpoint. And the problem is that those income and net worth requirements have been in place for years. I heard the number at one point, but I'm thinking it's like 30 or 40 years that number has been left alone. And so there's been debate that number needs to increase to $1.5 or $2 million of net worth before an individual can invest in that way. So that's what venture capital is. Excuse me. All right. So angel capital is similar in that these individuals have to be they have to qualify as an accredited investor according to the definition of the SEC, again the Securities Exchange Commission. However, these individuals, angel investors, don't take their money and give it to an investment banker, a venture capital person. They don't give their money to the venture capitalist and say, go find me something and invest well, and I'll look for a check back, dividend checks every so often. That's not the way that angel capital investors do it. Angel capital investors usually meet in a group setting. And we have a few groups here in the state of Alabama, and my hope is that a few more will be formed in the years ahead to help facilitate this. But I'm jumping ahead a little bit. But these individuals who are accredited from the SEC standpoint will meet, at lunch or something. They'll have lunch, and what they'll do, they'll hear presentations from entrepreneurs who are seeking investment capital. They will give their business plan. And normally the business plan and the entrepreneur themselves have been screened by some group manager or some other individual that is affiliated with the Angel Capital Group, so that not just any and everybody can come and give a presentation and try to get money. They have to go through a screening process. But once you do, at least you're that far along. That doesn't guarantee that you're going to get anything, though. What makes an angel capital group different from a venture capital group or a venture capital investment is that the individuals, those accredited investors, they make their own decisions. Whereas in a venture capital setting, they would say, all right, I commit $25,000. I'm going to give you $25,000, Mr. Investment Banker, and I want you to go find something for me. They don't. The investor has no say over what the investment banker does, or where that, what type of industry it's in, where it's located, how much they commit to each business, each project potentially. They have no say over it. They're giving up control to someone else because they have some level of expertise supposedly, and generally, as an investment banker, they're not going to be able to attract investment dollars unless they have done it in some setting, some form, albeit maybe small. Okay, so however, with angel capital, those accredited investors, they make their own decisions. They have those businesses that are seeking money make a presentation to them, and maybe not individually, but in a group setting. Certainly, there are individual angel investors, and I think that your book talks about that here. The first column there on page 500, individual angels, and then you've got angel networks, which are sort of the format that I'm explaining now. And that's advantageous because the entrepreneur only has to give that presentation one time, and there may be 30 people in the room. There may be 70. You just don't know. There may be 5. But at least you're not having to go to individual potential angels and give that presentation one-on-one, over and over and over again. That's time consuming. Time that you need to be spending doing something else with your business. And so that's one of the advantages of an angel capital group or an angel network, is the ability to tell your story to numerous people at one time in one setting. Okay, so the angels, they can, in an angel network or an angel capital group setting, they can say yes, they can say no, and their decision does not impact at all, hopefully, the person sitting next to them or the person sitting next to them. This person may say no. The person sitting next to them may say yes. I want to do it. I like what they have to say. Or, I have some expertise, and I understand that. It makes sense for me. So they individually can make that decision. And the person next to them may also say yes. Here's another differentiator, is that previously in the example of the venture capital investment fund, we said that maybe they require $25,000 to participate in that. Well, every person who says yes that they want to invest in it, they understand it, they like the idea, they can choose what dollar amount that they want to put in. There may be some minimum level, maybe $5,000 or something, but if they wanted to do 10,000, 15, 30, 75, whatever, up to whatever dollar amount the entrepreneur is actually seeking, they they have that freedom and flexibility, and they may say yes to this one in a very high dollar amount. They may say yes to the next one in a, maybe $5,000. They may say no to a third deal. And so that's kind of the structure of an angel capital network or an angel capital group. And as I said, there are a few groups here in the state of Alabama. There's one in Huntsville that, from what I understand, is doing fairly well. There's one in Birmingham. I don't know the success of them. They've only been around a couple of years, and I'm not sure what kinds of deals that they've actually been investing in. I've heard talk that there is one in Montgomery and possibly one in Mobile. I'm not completely certain on that though either. But it certainly would be good to have groups, all over the state, so that entrepreneurs in all regions can make presentations to these individuals. And so I'm hoping that will come about in the years ahead. Okay, so that's Angel Capital. An angel fund is a pool of funds similar to the way that I explained the venture capital, except that it's more local in nature. Oh, that's another thing. Venture capital investments generally are, well, as I said, the decisions are made by the investment banker, the person that's ultimately in control of the fund or the pool of money. They'll make the decision about what industries. They'll make the decision about what businesses, and those are not always located. Generally, not located in the cities where the individuals are, where the money's coming from. So, for example, if you have someone in your area, maybe there may be 2 or 3 or 4 individuals, or maybe 20 that could participate in an offering like that. However, they may not, and it may be a small town. These venture capitalists may not be very willing to invest in businesses in small towns. There may be some great businesses there, but what they're looking for does not, may not fit with the businesses that are opening up shop there. So this is another differentiator of angel capital, is that generally those individuals, because they are local, they want to see good things happen in their hometowns or wherever they're located, or at the very least in their region or in their state. And so they will make their investment decisions a lot of times based on the businesses being located in their region, or specifically in their city where they're located, because they want to see jobs created there. They want to see increased money flowing through the economy in a region, and they believe that this will help do that, and it certainly can. And so that's an advantage. Certainly there are advantages of the venture capital setup, but there are also advantages of the angel capital setup. So understand the difference. Now, that being said, as I mentioned earlier, it's very tough to secure this type of financing. These individuals, and there's I wish we had a chart that was similar to the one on page 499 that talked about the types of equity investments and the different stages that they're out there. If you do a web search, the stages of equity investment. You've got your personal investment of the owners. You've got your friends, families, and fools, and then you've got private investors. Then you've got angel investors. which can be private investors also. Then you've got angel groups, and then somewhere down the road you've got a chance at venture capitalists. However, those are very rare. They see maybe dozens of plans come across their desk, maybe in a day, I don't know, certainly in a week's time, and they just can't do everything. They're looking for certain things. They're looking for high growth. Honestly, that is the big thing, is they're looking for high growth potential. And if you are opening up an auto body repair shop, now while that might provide a good income for you as an individual, it's not. These venture capitalists, they understand the way these businesses operate, many types of businesses, and they know that the return, the extra profit is not going to be there for them. And that's what they're looking for. They're looking for two things: high growth and an exit opportunity. And what I mean by exit opportunity is that means at least the potential for taking that company public. What I mean by going public is having it ultimately listed on a stock exchange. When that happens, the value of the company just shoots up tremendously, and because of their involvement and the level of ownership that they've taken, the value of what they have goes up tremendously. What's the likelihood of Joe's auto body repair shop going public? I would say zero. I don't know of any of those types of businesses that have done so. Now you may surprise me, and a venture capitalist also. We talked about what was the CarMax? I don't know if CarMax is a publicly traded company or not, but that's one of those old style businesses. Basically used cars that some entrepreneur got a hold of and found a new model for, and they may very well be a public company now. But it takes something very special and very unique to do that. Outside of that, you've got to be a high growth, either technology, healthcare products. Something like that related, in order to catch the interest of venture capitalists. Everyone thinks that we need venture capitalists in our town. Well, they don't care about my hometown where I live. They very likely don't care about most small towns, 99% of small towns in the state of Alabama. And so I don't want you to think that's an option down the road. I want to be realistic with you and tell you about the types of the sources of funding that you might actually can get. Okay, and so. A lot of that is here in the book, and I've spent enough time already. I see we're at the 46-minute mark, so I need to move on. I'm going to pull some information from some other sources that I have that are not in your book, but I certainly want you to be aware of. Okay, let me get things straight here. Because of the decrease in the level of lending by traditional banks, a lot of businesses are seeking alternative sources of financing, and a lot of times, if you're a business owner, you have to get creative in how you do this. Not only in the startup phase, but also in if you have at many places along the way, if you need financing to get through a tough time, to meet payroll, maybe you need to hire a couple of new employees to really promote your business. Sometimes you have to spend money before you actually have the money to spend, and so that requires that you need the cash flow, and if the receipts aren't coming in for that, then you gotta find it some other way. So a couple of the new I hate to say trendy, but maybe popular ways that businesses are doing this are trade credit, and what trade credit is this is very similar to receivables financing. If you sell something to a customer, you may not yet receive your money, your payment for it, and so you have what's called an accounts receivable, and that's that may be ongoing, You may have built up a high level of accounts receivable. If you do, you have a problem. You need to look at why customers aren't paying. Is it an external thing? Is it the people that you're dealing with are not very trustworthy, or not? Maybe they're just not receiving notices. They just maybe there's something in your business that you're not sending out the notices. You need to talk with the employee who's responsible for that. For whatever reason, if you've got a high level of accounts receivable, that is actually a source of cash flow, and it's worth something. There are businesses that are built around providing that cash flow. What they will do, they will buy those receivables from you, and the word that they use is sometimes called factoring or receivables factoring. And so they will buy those, and what that does is that gives you the cash flow now to be able to to meet payroll, to buy a new piece of equipment, or something for the office, or to buy supplies that you need to to restock your shelves, or raw materials, or whatever it is. It frees up that for cash flow, and then they buy it at a discount. They're not going to do it for free just because they like you. They buy it at a discount. Anywhere. Well, it depends on what they expect, what they truly expect to collect on it, and they have experience on this, and they know about what they will be able to collect on it. And sometimes customers don't pay, and so they're out now, and so and that's one way you can reduce your risk of customers not paying. If you feel like that this the last 6 months of you've sold to some untrustworthy customers. Now, not that you want to be crooked, but you have a huge level of risk built in there. You may not collect at all. So if a factoring company comes to you and wants to buy it for a 8% discount, well, you're only getting 92% of what you sold, but at least you're getting 92% and not potentially 50 or 60 or 70% of what you sold. And they're willing to take on that risk. They've done a lot of calculations, a lot of studies about that, and so they know fairly well, and they have some tactics for collecting on those receivables. So that's factoring, receivables, factoring, and trade credit are all similarly related. Let's see. What was another one? Okay. So the source here. Getting advance payment from customers. A lot of times, I'll use that. This is a very large scale example, but it's easy to understand. The plane manufacturing company Boeing, they will receive orders for a plane long before and payment in a lot of cases, or maybe at least a percentage of the payment, long before that plane has ever been the first bolt has ever been put into place, or the first seat has ever been put in an aisle. So that they've got money coming in based on demand for what they are going to produce. Okay, and so that's one way you can structure. One way you can increase cash flow is to get your customers to pay up front. Now, depending on what you're offering, some may do that. Some may do it in a small percentage. Maybe they'll do 25% or 10% or something, some lesser amount. They may not do the whole thing. They may not pay 100% of what they're going to owe you. And certainly, it's if it were you making that decision for your business, it'd be tough to say, yeah, I'm going to agree to that. I'll pay you 100% of it, and then you may be out 100% if they don't follow through with their side of the bargain there. Okay, but getting advance payment from customers is a way to increase cash flow, and that's a form of finance. Okay, all right. Extending your we talked about accounts receivable earlier. You also have accounts payable. That's monies that you owe to someone for product or service that you have received. Okay, let's say that you're buying raw materials that are going to go into the manufacturing of some product that you're going to turn out. Okay, well, if you can extend the amount of time that that company, excuse me, is willing to wait before receiving that payment, then that's a source of financing, especially if they do it with for no cost. There are trade terms, trade credit terms that we talked about just a few minutes ago, that you can define in that contract or in that agreement, the payment agreement. And you can stretch those out to you may start out at 30 days, and then if you develop a good relationship with them, you say, look, let's do this on 60 days. I'll pay you in 60 days. Well, you've basically gotten that money for free for an extra 30 days. If you can stretch it out to 90 days, all the better. You may have a hard time going out much longer than that, but you definitely won't get it if you don't ask the question. Now, that's not extra money that you receive in, but it is certainly an extension of time for paying what it is that you owe, debts that you've incurred. A couple of other things here. There are regional agencies, federal programs that offer assistance in guaranteeing loans. Maybe they have a community fund that they have available for business startups. And a lot of times it's written into their bylaws the amount of dollars that they are required to lend out or to fund out in a year's time. And so it behooves you to find out if those types of things exist. Check with your economic development office in your region, or your chamber of commerce. Hopefully will be aware of those things. That's one thing. A lot of these agencies don't communicate very well, and letting it be known that they have these services. And so a lot of other agencies don't know to refer you to the right sources, and that's unfortunate. But you got to ask a lot of people. Do some agency checking. Talk with attorneys and accountants, and find out what who they know, what they know, and try to get in front of the right people. A lot of times it is who you know, and asking the right questions. Okay. Let's see. Peer lending. Many of you have heard of. Let's see. I had an article pulled up here, and excuse me while I give me just a moment. Peer-to-peer lending actually is what it's called, or peer lending. There are four or three of the more popular sites are prosper.com, lendingclub.com, and peer-lend.com are what I'm finding here. Now, the way that peer-to-peer lending works, if you're not familiar with that, it's essentially like a social network of lenders. An individual can sign up on the site, and some of them may charge you a fee to be a part of it, and many of them may not. Maybe they take a small sliver of the interest for the privilege of you being on the platform, and for a prospective borrower having access to it. But what they do is they will group together many loan dollar amounts from dozens, if not hundreds, maybe thousands of individuals, in order to meet a need from someone who wants business capital. Let's say that you need $10,000 to get your business started. Okay, well, you can go out to one of these peer-to-peer lending sites and put that out there, and put some information about yourself, and I think you also have to be willing to provide information from a credit report, because at that point it's based on you and not your business cash flow, because you may not have a business yet that can show that you're selling X amount of product or service, and so it's based on your personal credit, and so you have to be willing to at least be subjected to a credit report, and maybe not your personal information, but they may just say, no, it's within this range, and therefore we deem this person an acceptable risk, something like that. Um, so you may have individuals may say, all right, well, I'm willing to lend $25, or I'm willing to lend $125, or $1,000, and these individuals that can go on there and register themselves, they are viewing it as an investment, almost the way a bank would. The bank is giving you money as an investment. They're looking to get interest back on it. Well, this person that goes on there and says, yeah, I'll lend $25, and I select this person over here. I like this person's business plan. You may have to submit a business plan. You may not. But I like their business idea, and I want my $25 to go to them, and so that's the way it works from that side of it. And what the peer-to-peer lending site will do is they will collect all these dollars from hundreds, or dozens, hundreds of thousands of sources, and they'll once the total of everything that everyone has committed to your venture meets whatever dollar amount that you're seeking, and they'll say, all right, here you go, here's the $10,000 that you needed. Okay, and then at that point, that I assume if not done this, but that would start the loan process, and the terms that you have agreed to would kick in, and then you'll have to start repaying a part of the loan each month. Excuse me, just the way you would a regular bank loan. So that's a new source, and I think there's a lot of people that are taking advantage of that on the low end of things. The low dollar amount needs, whereas a bank may not be as willing to fund that. So give consideration to that. Another, and I just had someone I referred to just in the past 2 weeks. To an attorney to help with this type of financing, and that's it's called convertible debt financing. If you don't know about convertible debt or convertible bonds, if you've ever studied in finance classes about lending, then what a convertible bond is, and similarly convertible debt, what that means is that it's just a loan that requires you to pay back just like a normal loan would. You have the terms that you agree to. You're going to pay the payments monthly. You're going to have a percentage rate. Maybe it's a fixed rate, maybe it's a variable rate. It depends on what you agree to and what the lender agrees to. And then you're going to have a monthly payment, and you'll have a term or a length of time that loan is going to stretch out to. It may be 1 year, it may be 5 years, it may be 20 years. It just depends on what you all agree to. Again, what makes a convertible loan or convertible debt different is that at some point during the tenure, during the time of that loan, the lender has the option of converting it, or convert, switch, change is what that word means. They have the option of converting it to ownership in your company. So instead, and what happens at that point, the loan goes away. If they actually convert to ownership, they have, and again, depends on what you write in there, but let's say that you borrow $100,000. Okay, and at the inception of the loan agreement, you say, all right, in 5 years from now, I'll give you the option to convert whatever is left. Let's say, and you would need to have some, a fair amount of time left to be able to do this. But for illustration purposes, let's say it's a 20-year loan, and 5 years into the loan, they have the option or the right to convert that to equity ownership. So basically, they can take stock in your company at that point. And you would define how much they get. Let's use the 25% example that I think we used earlier. for simplicity purposes. But let's say at that point they would get 25% of your company if they wanted to. Now, of course, if your company's not doing well and not profitable, they're not going to want to do that. Or if it's just marginally profitable, it doesn't really benefit them to convert to equity or stock ownership at that point. Well, they would run the numbers to see, but on the surface, if you're just marginally profitable, it probably would not benefit them very much. They would actually get more back by continuing to receive the loan payments that were outlined at the inception of the note. And so they have that right. You gave that to them whenever you signed the loan documents. Now, obviously, it's not something they can sneak, pull over on you. It has to be written into the document that way. But it is an option, and there's a couple of advantages to it. One, for you as the borrower, for that conversion feature, for that right. That right is worth something, because, as I said earlier, equity, if a company's doing well, is worth more than debt. And so as the lender has an incentive that the company is going to do better. And so for that incentive, you actually can get a better rate. So maybe you could only get a 10, your interest rate would have been 10% if it's just a straight loan type of situation. But if you do a convertible loan type of situation, maybe you can get it for 8.5%. Well, that's real money that's saved right there. Depending on the size of your loan, you've saved 1.5%. That goes straight to the bottom line. That helps you be more profitable. And actually, the lender likes that too, because they want you to be more profitable. They want you to be in a better financial situation so that you're going to survive, that you're going to do well, and ultimately be profitable quicker, so that when that time comes, when that conversion option gets here, that they will have the incentive to do that conversion. Okay, so that's their incentive, is that you will be profitable, and that it's worth it to them to convert to the equity. Now, what happens, as I sort of alluded to when I started talking about this, if they convert to equity, to the ownership, the stock position in your company, the loan goes away. They have given up all rights to any future debt payments. So they're basically saying, look, we would rather now have equity ownership in your company than to continue receiving debt payments month after month after month. So, that's great. It's good and it's bad, because you've given up equity ownership, but you've also immediately dropped your expenses. Your monthly expenses have gone down. So that's one of the hot new trends in equity in small business finance, is convertible debt or convertible loans. And as I found out in recommending this to a couple of businesses here recently, there aren't many attorneys even that are very familiar with this to be able to help structure the loan for that kind of governs this. And so, not that it's new, it's not widely used, but it is something that is becoming more popular as businesses are seeking alternative sources of financing. So I'm this, coupled with your other videos, I'm over my time, so I'm gonna stop here. And just as always, y'all are doing a good job for the most part. Just read through and understand the chapter. The quizzes are coming, straight from either the videos or the textbook. I'm not giving you anything that's not from one of those two sources. And in many cases, it's word for word. So if you have viewed the videos and read the textbook, you should be making 14 out of 15 or 15 out of 15 every single time. And I'm getting to a point where I sort of expect that now going forward, because the business plan, the marketing plan, the finance plan, the business plan are going to be very crucial, and are going to be judged accordingly for your overall grade. So we'll end now.